Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about EnerSys quarterly report. EnerSys is a leading provider of stored energy solutions for industrial applications worldwide. The company operates in 4 key segments: energy systems, motive power, specialty, and new ventures. The energy systems segment offers a wide range of products and services, including uninterruptible power systems, UPS, switchgear and electrical control systems, large-scale energy storage, and thermally managed cabinets for electronic equipment and batteries. This segment caters to various industries such as broadband, telecom, data centers, renewable energy, and industrial customers. The motive power segment provides power solutions for electric industrial forklifts, automated guided vehicles, floor care equipment, mining equipment, rail equipment, airport ground support equipment, and other specialized applications. In addition to these segments, EnerSys also offers starting, lighting, and ignition (SLI) applications in transportation, energy solutions for satellites, spacecraft, commercial aircraft, military, and defense applications. The specialty segment also provides portable power solutions for soldiers in the field, as well as medical devices and equipment. The new ventures segment focuses on energy storage and management systems for demand charge reduction, utility backup power, and dynamic fast charging for electric vehicles. This segment also offers battery chargers, power equipment, battery accessories, outdoor cabinet enclosures, and related aftermarket services. EnerSys sells its products through a network of distributors, independent representatives, and internal sales forces. With a history dating back to 1991, the company has established itself as a trusted provider of stored energy solutions for various industries worldwide. The surge in EnerSys stock price by over 72.58% in the past year can be attributed to several key news events and strategic developments. One major contributor was the company's benefits from IRC Section 45X Advanced Manufacturing Production Credits, which are estimated to contribute between $135 million and $175 million annually through fiscal year 2029. The development of a lithium-ion gigafactory with DOE funding is another significant factor. This project, valued at $199 million, will produce advanced lithium-ion cells for critical applications across commercial, industrial, and defense markets, signaling strong future growth potential. Additionally, EnerSys' strong fiscal year 2025 financial results, including a record adjusted diluted earnings per share of $10.15, further boosted investor confidence. The company's strategic acquisitions, such as the Bren-Tronics acquisition, have also contributed to its growth. Furthermore, new product introductions and partnerships, like the EnerSys BESS energy storage system and Sonova Sync charger, have helped businesses optimize energy supply and manage costs more effectively. The company's efforts to reduce costs through a workforce reduction plan are expected to generate an estimated $80 million in annualized savings. EnerSys' commitment to shareholder returns is evident in its increased stock repurchase authorization and quarterly dividend. Finally, positive analyst upgrades and raised price targets have reflected growing confidence in the company's strategic direction and future prospects. These combined factors have contributed to the significant appreciation of EnerSys' stock price over the past year. EnerSys maintains a market capitalization of $6 billion, broadly in line with the industry peer group. EnerSys trades at a lower price-to-earnings ratio of 19 times and a higher price-to-book ratio of 3.36 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various factors that impact a company's financial performance. On the positive side, higher demand from customers in key markets such as motive power and industrial batteries has contributed to revenue growth. Additionally, increases in sales from products and services, revenue recognized over time for customized products and services, and pricing increases have all played a significant role. Furthermore, specific segments within the company have experienced notable growth, including the Energy Systems segment with a 2.6% increase in revenue and the Specialty segment with an 8% increase. Foreign currency translation has also had a positive impact on revenue, contributing to a 2% increase in both Q3 and 9 million. On the other hand, revenue decline can be attributed to lower demand from customers in certain markets, such as the motive power market. Decreases in sales from services and revenue recognized over time for customized products and services have also contributed to this trend. The motive power segment has experienced a 1.7% decrease in revenue, while the corporate and other segment has seen a significant decline of 22.7%. Notable events that have affected revenue include the closure of the Hagen, Germany facility in fiscal 2021 and the reduction of approximately 200 employees. These events have likely had a negative impact on revenue, although their specific effects are not quantified in the provided data. The net income of the company experienced a significant decline between December 28, 2025 and December 29, 2024. The decrease was substantial, with a drop from $114,812,000 to $90,373,000, representing a 21% reduction in net income for the quarter. Furthermore, when comparing the full-year results, there was also a notable decline of $50.9 million, 19%, in net income, from $267.2 million to $216.3 million. The decrease in profit margins was another key indicator of the company's financial performance. The gross profit margin saw a significant drop from 32.8% in 2024 to 30.1% in 2025. Representing a decline of 280 basis points in Q3 and 60 basis points over 9 months. Similarly, the operating earnings margin decreased from 15.7% in 2024 to 13.5% in 2025, with a notable drop of 90 basis points in Q3. The reasons behind these changes were largely attributed to increased depreciation and amortization expenses, which rose by $10.2 million. Additionally, the company experienced a decrease in prepaid and other current assets, resulting in a use of funds worth $145.5 million in fiscal 2025, compared to a provision of funds worth $29.5 million in fiscal 2026. These factors collectively contributed to the decline in net income and profit margins, highlighting areas where the company needs to focus on improving its financial performance. The company's financial performance has shown a significant improvement in generating operating cash flow. A comparison of the data from fiscal years 2024 and 2025 reveals a substantial increase in net cash provided by operating activities, rising from $125,110 to $403,609. This indicates that the company is now generating positive operating cash flow, which is a crucial indicator of its financial health. The trend continues into fiscal year 2026, where operating activities provided cash of $403.6 million, further solidifying the company's ability to generate positive operating cash flow. This increase in operating cash flow suggests that the company's business operations are becoming more efficient and profitable, allowing it to generate a significant amount of cash from its core activities. The company's debt level has undergone significant changes in recent years. While short-term debt has only slightly increased from $28,502 to $29,759, long-term debt has seen a more substantial rise from $1,083,541 to $1,149,406. Total liabilities have also increased from $2,051,760 to $2,152,778. However, the interest expenses have shown a mixed trend. Initially, there was a decrease in interest expense from $14,853,000 to $14,1 $145,000. But this reduction is offset by an increase of $4,500 due to a net unrealized gain on derivative instruments. Furthermore, despite the significant increase in debt level, no specific information is provided on the change in interest expenses. The company has also taken steps to manage its debt through various financing activities. In January 2024, it issued $300 million in senior notes due 2032. Additionally, cross-currency fixed interest rate swap contracts with notional amounts of $150 million each were entered into in December 2024. These moves aim to optimize the company's financial position and mitigate potential risks. In terms of cash flow, financing activities used $241.4 million in the 9 months of fiscal 2026, compared to provided cash of $328.9 million in the same period last year. This indicates a decrease in cash inflows from financing activities. Overall, while there are some discrepancies and conflicting information across different pages, it is clear that the company's debt level has increased significantly, but its interest expenses have shown a mixed trend. The performance of various segments and regions in the company's latest financial report reveals a mixed picture. On the positive side, the Americas segment showed significant growth, with a 10% increase in revenue year-over-year. This is also reflected in the Motive Power and Energy Systems segments, which saw income increases of $22,830 and $34,435 respectively. In contrast, the Europe segment struggled, experiencing a decline of 5% in revenue compared to the previous year. The Specialty segment also underperformed, with a decrease in income of $21,928. These results indicate that while some areas are thriving, others require attention and improvement. Management's outlook for the company is one of cautious optimism. They are actively monitoring new legislation and guidance related to taxes, indicating a focus on regulatory compliance. In terms of financial performance, management expects a pre-tax gain of $5,081 in the coming year from hedging instruments. The company is also taking steps to improve operational efficiencies through restructuring programs, which will help mitigate the negative impact of interest rate increases on outstanding variable rate debt. Management believes that their international structure will provide some protection against potential tariffs. In addition, management is committed to strategic inventory building and anticipates growth. They expect material benefits from their restructuring plan to begin in the third quarter of fiscal 2026. Overall, management's strategy appears to be centered around improving operational efficiency, managing financial risk, and positioning the company for future growth. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, one notable deal was the purchase of Bren-Tronics Defense LLC for $206.4 million in cash consideration on July 26, 2024. Additionally, the company acquired a specialty segment for an estimated $1 billion. On the other hand, the company has also made several divestitures. One notable example is the sale of its facility in Hagen, Germany, which resulted in a gain of approximately $1,142. However, this was offset by charges related to the closure of substantially all operations at the same facility, totaling around $60,000. The company has also closed facilities in Silmer, California and Ooltewah, Tennessee, with estimated total charges of $13.7 million and $18.5 million respectively. It's worth noting that while the Hagen, Germany facility was retained with limited functions and personnel, the specific details of this divestiture are not provided. The company's financial performance is reflected in its dividend payments and share buybacks. In terms of dividends, the company has consistently paid out a certain amount per common share over the past 2 years. For instance, in December 2025, each common shareholder received $0.2625 as a dividend payment. This trend continued in the previous year when shareholders received $0.24 per common share. In addition to paying dividends, the company has also invested in itself by buying back shares from the market. Over the past period, the company purchased 3,047,474 shares, worth approximately $303.7 million. These strategic moves demonstrate the company's commitment to rewarding its shareholders and maintaining a strong financial position. Concerns about inventory buildup and supply chain disruption are evident in the recent summaries. The total inventory increased by $55,382 from March 31, 2025 to December 28, 2025, indicating a significant buildup of stock. This is further supported by page 50, which explicitly states inventory buildup. Yes. Moreover, the company has incurred substantial inventory write-offs, with $1.5 million in charges for fiscal 2026. Supply chain disruptions have also been a major concern. The pandemic has caused global supply chain disruptions, leading to delays or cancellations in shipments. Natural disasters and man-made calamities have further exacerbated these issues, affecting the company's infrastructure, supply chain, and facilities. The ongoing Israel-Hamas conflict has periodically disrupted some shipments in the Red Sea. The facility closure in Monterrey, Mexico, due to production being moved to an existing facility in Richmond, Kentucky, is another example of how both inventory buildup and supply chain disruption are interconnected issues. This move resulted in significant non-cash charges related to inventory and fixed asset write-offs. These concerns highlight the need for the company to reassess its inventory management and supply chain strategies to mitigate these risks and ensure business continuity. That concludes the financial summary for EnerSys. Feel free to comment below, and I will be happy to answer them when possible.